The best part of that was he committed. You heard him. We got it on video that we're going to be here every year doing on-demand and for perpetuity. So we're all about that because they pick up the F&B, which is a great thing. No, it's HP is an amazing partner of ours. They sponsor all our other events, and we really, are cheering them on. I think if I were working for HP, I'd be pretty inspired by what I heard today. So now that I have you awake, we're going to move on to a very important session, which is called M&A in the Cloud. You heard it here with Leo. He's going to be buying some companies, it sounds like. He's not going to be buying SAP, which will be interesting to see if that hits the news. We have an amazing group of people that are on this next session, and we have an equally amazing host who represents, is a partner at Shepherd Mullen. If you don't know Shepherd Mullen, they're one of the larger law firms on the planet servicing our world. They just opened a nice office in downtown Palo Alto, so if you want free lunch in downtown Palo Alto, you can give them a call. And their main dude over there, Louis Lahoe, right here, who's coming out to give me the hook, is going to be the gracious moderator of this next session. So let's give it up for Louis and his distinguished panel. Is that okay?
Well, somebody's name got pronounced correctly today. Thanks, Tony, for that introduction, and thanks everybody for coming out to On-Demand this week. What a great day. We got to hear Leo, so many interesting people in the crowd, and that you're going to meet on our panel today. So very honored to introduce Sheryl Chamberlain, who runs the VMware Alliance over at EMC. Give it up for Sheryl. Sheryl, come on up. Just behind Sheryl, Paul Kwan, who runs software investment banking at Morgan Stanley. Thank you, Paul. Ken Allen, who runs software investment banking over at Blackstone. Ken. And Andy Johnson, who runs corporate development at HP. Thank you, Andy. So I first want to give everybody up here on the panel a chance to introduce themselves a little bit more than I just did. But just to set the stage today, we really thought that given the topic and the audience, that really what would be interesting is to spark a discussion among our illustrious panelists about what's exciting in M&A in the cloud today. What trends are they seeing? What kinds of philosophies that they approach deals from? The problems that they see in execution and in valuation, and some lessons that we can all take away and apply in our own processes as we go forward in 2011. So, Sheryl, maybe if you could just tell us a little bit about yourself and what you do over at EMC.
Yes, so Sheryl Chamberlain, Senior Director at EMC, and I manage our corporate alliance with VMware. Now, do people wonder why there's an alliance between EMC and VMware? Raise your hands if you're wondering. John, don't do that. They really are operated as two independent businesses. So they need someone in between to make sure that we can work together as two organizations. So I manage the business, all the engineering integration, go-to-market, all of those important strategic initiatives between the two companies. So what these guys are doing around M&A, I catch it and try and make it work. Or make it work.
Thank you, Sheryl. Paul.
Thanks, Lee. So I run the internet software effort for Morgan Stanley. I've been about 11 years now. And at Morgan, we've been particularly focused on software as a service, having done the IPOs for companies like Salesforce, SuccessFactors, Omniture. Last week, we led the IPO for ServiceSource, which did pretty well. And then on the strategic side, we've been pretty privileged to have been involved in a number of the on-demand transactions, having worked on the Omniture sale to Adobe and ATG sale to Oracle a few months ago.
Ken Allen with Blackstone. I'm with the advisory side of Blackstone, some mergers and acquisitions and private capital raising. I run the cloud computing coverage effort at Blackstone. we're really focused a lot on infrastructure. We did the sale of Chamberlain to Dell recently, and last year actually did the largest deal in technology M&A, which was Xerox's acquisition of Affiliated Computer Services.
So hi, I'm Andy Johnson, and I think as the person introduced, I work here at HP. I'm very inspired by Leo, based on, I think I've heard, somebody asked me if I came this morning, I said no. I think we've been very consistent internally. I think we've had probably 6 or 7 presentations. I think that the HP in general is pretty excited about the strategy you heard Leo talk about this morning. So I've been at HP about 5 years. I literally work upstairs, so it was a very short commute for me today. And I lead the corporate development teams here at HP. I've worked on 3PAR, actually, against Dell, 3Com, ArcSight, Fortify recently. So a lot of the enterprise transactions have been kind of led out of my teams.
So you've had a slow year, Andy.
This year, yeah. Well, Vertica.
Is that all?
We mentioned that one.
I hope everyone can see we've got a really awesome panel of buyers and the best advisors in the business. Maybe we could start off. Ken, tell us how do you guys at Blackstone define the cloud?
Yeah, but it's an interesting question. I think people have different viewpoints on it. Certainly, if you kind of go back to when I started covering, I guess, cloud computing, which is really around the time of the hypervisor with VMware, and if you think about infrastructure as a service. Now it's kind of morphed into everything as a cloud company, whether it's a mobile company or a social company or an internet company, SaaS business, et cetera. And so I think the definition is increasingly broad, but generally it's, in my mind, using technology, computing power, storage, processing, et cetera, sort of in an on-demand manner where it's just in time, and you're sharing resources across a number of different applications and enterprises.
So, Paul, are you going to disagree with that?
I guess the one thing we'd add, that was good from Ken, says the financial model aspects. So we try and expand the concept of on-demand SaaS to kind of new kinds of business models and software. So we talk about recurring revenue models. We talk about customer lifetime value discussions. And so what we're trying to push with the public investor marketplace is understand that this is a technology shift, and then this has implications for underlying technology business models, which we argue and position hope will generate better returns that are profitably over time. And so we really focus on closing that loop between the technology is disruptive and the business models for SaaS companies can be very disruptive. Selling costs, less friction, higher velocity, cost of development, shared hosting leverage, G&A leverage. One of our companies that we're working with says they will get their G&A costs down from a typical public software companies running 10 to 15% G&A costs. They're a SaaS company. They want to get their G&A costs down to 3% of revenue. That other 7% is going to go to the bottom line, right? And so we try to kind of push the profitability and the business model aspects along with the technology side.
Thank you, Paul. Sheryl, Andy, anything else you want to add to what is the cloud?
No, other than it is a broad topic. I think the way we think about it is from the consumption side and how we deliver technology. So we just think it means big changes in terms of how we deliver technology to our customers, and then we think it's big changes on how consumers are going to consume information and technology. So for us, it's a lot about what you said, changes in the business model, things like that.
Thanks. So before we dig into the next portion of our segment, I thought it would be helpful to give everyone an update on where are we in the M&A markets, where are we in the finance markets, and I'll just draw your attention to a few quick slides up on the screen. Right here is a slide that shows you the annual investment in new companies by venture over the last 10 years, and as you can see, 2010, especially the second quarter, was a great improvement. Q3 dipped a little bit, and Q4 was a nice quarter-over-quarter as well as sequential improvement. And so, anecdotally, the data isn't out yet for Q1 2011, but so far so good, I would say. Where is capital getting deployed? Up on this slide, you're going to see, courtesy of the NVCA, that software really is just crushing it. And it continues to do so. This shows you Q4, but I can tell you Q3 and Q2 were just the same. Software was really where it was at. So couldn't be a more topical subject. This next slide shows you real quick where the what the volume of exits were. And again, I think you can see that 2010 was the best year for venture-backed exits in at least 3 to 4 years. So good momentum coming into 2011. Here's a slide showing valuations, courtesy of our friends at Morgan Stanley. And as you can, nope, this one is courtesy of you guys. And as you can see, it's not us.
We give everyone else credit here. So.
That's right.
As you can see, valuations are nowhere near the highs that they were in January '06, which one would think would be conducive to yet more M&A, which is what we like. Next slide, Ken, I'd love it if you'd add a word here, courtesy of our friends at Blackstone. Ken, I'm not sure if you can see this slide.
Yeah, I can see it. So I apologize for those in the audience that can't see the labels. It's a little difficult to read, but I think all you need to know is the red line is cloud. And obviously there are not too many publicly traded cloud companies. But what we try to do is lump in companies like Apple and Google and VMware, RIM, Salesforce.com, et cetera, into an index, which we just continually track over time. And it's just interesting when you look at that chart to sort of look at back where we were March of '09 in the depths of the recession. If you look at that line, it basically didn't occur, and sort of we've been off to the races ever since. One of the things that we focus on a lot is, and we'll talk about on this panel, is really what drives value. In terms of buyers looking at transactions and sellers looking for exits. These two charts are really just simple regression analyses, and what we've done is taken the sectors that we had on the last slide, so again, cloud computing is in red, up and to the right, and really just regressed both revenue multiples, TEV to revenue, and then TEV, or I guess in this case PE, on the right side, versus growth. And so, in the left side we have revenue growth, 1 year of revenue growth versus forward revenue multiples. That's a pretty good correlation of almost 90%. On the right side, it's the same story. In this case, long-term EPS growth, which generally means long-term 5 years. So that's analyst forecasts of what the next 5 years of EPS growth is going to be versus PE. And again, it's a correlation of 90%. So in terms of the question, what drives value, what do investors look for, it's really growth. And I would also note that it's not profitability, at least according to this data. If you do the same regression on profitability versus revenue or PE multiples, the relationship basically breaks down.
Takeaway for members of the audience: it's not about profitability.
Grow fast.
Grow fast.
Except for customer unit economics. We'll come back to that.
We'll come back to that. Next, I wanted to show how much money is on the balance sheet of our big buyers in Silicon Valley. Microsoft, Cisco, Google, Apple, Oracle, they're sitting on billions and billions of dollars in cash. Not to put our panelists on the spot here, but Sheryl, Andy, can you comment on why you sit on these cash piles? I should say that HP and EMC are sitting on smaller cash piles and put their money to work more than the other guys, but Sheryl?
Do you really think that we're sitting on that cash? I think we're just making so much money when the cash is growing. We're definitely investing. We bought Data Domain, which is, I think, people in the Valley were aware of the investment we made there. Recently bought Isilon. So we're definitely looking at assets, looking at opportunities to make additional investments at all times.
Yeah, I think HP has a pretty sophisticated capital allocation, which takes into account things like share buybacks, dividend, and how we want to spend money on M&A. I would say in the 5 years I've been here, we've never been constrained by dollars. In other words, we don't really ever say, is there a deal we can't do? EDS was a $13 billion deal. We raised money to do it. I think, to be honest with you, it's a matter of finding the right companies. We've never been capital constrained since I've been here. So it's more the right fit with the right companies more than anything.
So, Andy, tell me, are you seeing a gap in valuation between the companies that you're looking at and what value you're going to put on them and the value that sellers are asking for? And I ask this because, as we saw in a couple of the slides ago, the IPO market is back, and Paul's firm took out ServiceWorks public last week, and traditionally IPOs get larger valuations. Are you seeing a disconnect between buyers and sellers on value?
Well, sellers always want too much money, right? No, I think it's just, it's two sides trying to negotiate the best deal. I do think we are in an environment where a lot of companies think they're going to grow very fast, or somehow they believe that there's, this strategic value in what they have, and that, particularly at smaller companies, I think there's a feeling sometimes that a larger company like HP can't really duplicate what they have, so it's a little bit like having the last house on the block in real estate. And so I think sometimes there's a bit of an unrealistic expectation that the big buyer has deep pockets and, what's an extra 20 million, what's an extra 30. But, we have a fairly disciplined process about building business cases, and we build in synergies, and it's got to work for us. And in some cases, if it really works, we're willing to pay more. In other cases, we simply just say we're not going to get there. So it's a little bit of a mixed bag. I think it's. I will say things feel a little bit more frothy now relative to a year ago, though.
And has there been any change to the approach of how to bridge that gap in value that comes out? Is HP open to using stock? Are you seeing more earnouts to bridge that gap?
We typically haven't. Earnouts for us, anytime we've tried them, they get very messy. And so I think, while we'd never say never, I think culturally we've just not seen them work, and sometimes they tend to be good mechanisms to keep a deal discussion alive. But my experience is what happens is when you get into the mechanics of it, and the CEO of the acquired company says, hey, how do I ensure I have the right budget? And it just gets very messy, and we either find a way to get to a price that works, or we decide to end the discussion at that point. So, we're still pretty much classic, here's a price, let's get the deal done kind of thing.
Thanks. Paul, Ken, are you seeing big gaps in valuation between your clients on the buy side and the sell side? And
yeah,
Paul, you want to take that?
I'll jump in. I think we continue to see that gap. I think it's probably, to Andy's point, expanding with the kind of the bit of resurgence in the IPO pipeline and the IPO activity, which is really, in our view, driven by that growth that Ken talked about. There's just a paucity of public company growth. Your average public internet software company is growing, 10%, 15% plus or minus, and so the opportunity to buy growth via IPOs or earlier stage companies is actually quite interesting to investors. So the premium for that growth, what is that premium worth from a public market standpoint? If you actually graph all the SaaS companies against their growth, which is probably a subset of the data there, you'll see the correlation from 3x revenues to 8x revenues align carefully with forward growth. So we do think there's a bit of that gulf. How we've tried to bridge that gulf between the buyers and sellers is two aspects. One, really understand the synergies that Andy talked about. Try and validate those either through partnership before or customer anecdotes. Really quantify the value of that cross-sell, upsell opportunity. Two, amazingly, is the value of the people, particularly in SaaS and on-demand. Culture and the DNA and the expertise the startups and the innovators have versus the incumbents is really differentiated in our view than enterprise. And so what is the value of a great ops team or a great development team or a great sales team that understands SaaS? And you can imagine in a lot of the work we do in SaaS M&A, we're articulating the value of that team, the quality of that execution capability, and you can't find that elsewhere. Which gets to kind of a last point, which we think is one of the challenges in SaaS M&A, not to go on and on here, is not just the cultural gap from the acquire wars, perhaps not fully understanding or having their entire team understand the power of the models, the business models, some of the opaqueness in the financial metrics. Billings could be great, revenue may be lagging, and then the startups who understand all that. And so there's not just a technology gap or a financial gap, there's also kind of this cultural awareness gap, I think, as we try and bring companies together.
Yeah, just on the gap question, I definitely think that there is, with the public market threat, now a lot of entrepreneurs and smaller companies, and we work with a lot of, kind of privately venture-backed startups that they see Facebook, they see Zynga, they see LinkedIn, et cetera, and the fact that the public markets are generally open to them now. And when you see that, and if you have a good business and you see the runway, going forward, why would you sell? The IPO probably should be the plan of record. And if you're actually putting yourself up for sale, particularly if it's a structured auction, that maybe you're sort of broadcasting to the market that you're not a great asset. And so, in fact, what we advise companies a lot is to, if you're a small company, the plan of record should be the IPO, and if somebody comes knocking on the door at some point, then engage in discussions, but not necessarily proactively go out there and put up the for sale sign. Not in this environment.
That's helpful. Sheryl, we just talked a lot about people and cultural gaps and the challenges of integration. Tell us some of your experiences, at EMC and beyond, about the challenges of integrating people and cultures.
Yeah, if you look inside a business today, you have business units that are operating on just East Coast to West Coast, and the cultures are very different. And now you're bringing in a whole new organization that you have to operate with. And as you were saying, sometimes they're completely different. Hey, didn't you do the VMware deal?
Yeah, it's a good deal for you guys.
Yeah. What do you think about the cultures on that one? Were you in the room with Joe and Diane? What was that like?
I was. I think in hindsight, it was a very competitive process, and EMC, I think, stretched on that one. In hindsight, obviously, that was the greatest acquisition in the history of software. So, kudos to you guys for picking on that.
Yeah, but at the same time, there you had, again, a software company, now just taking away the East Coast, West Coast, but a software company that's operating in a West Coast culture, now, working very closely with a very big corporate storage company. So what do you think about it when that happened?
You left autonomous, though.
Yeah.
You didn't try to integrate.
Well, that's why I was asking Andy, what was your view as a strong, you're one of the top VMware partners. You are the top VMware partner.
HP is, yeah.
Yeah.
Fortunately, yeah. I wasn't at HP at the time, but I think in general, I think the general perception was it was a great deal.
Yes.
I think people saw the promise of what it was. I don't think anybody saw where it would go. Otherwise, a lot more people would have bid a little bit higher prices too. So.
I agree. But even when you look inside of VMware, because I work with them all the time, and they're going through an acquisition phase. SpringSource, which is very different than the infrastructure products they have. So there's a whole nother culture there, not only within the company, but the customers that they're dealing with. So culture is constantly coming into what we have to think about when we're bringing companies together to ensure the overall success. It's fascinating.
So if I could just throw in that Sheryl, so if you kind of ask people for the best deals, I'll go to Andy on this one, the best deals that a company has done from an M&A standpoint, if you'd gotten the price 5-10% higher or lower, did it really matter? Right? And obviously in the case of VMware, it didn't. But at the time of that deal, that 5%, 7%, 3% gap made the difference. Right? How do we change the game slightly so that people don't make those mistakes and or people get credit from the public investor marketplace to stretch for the right deals and not have their stocks get penalized? You would jump on that.
Andy?
Yeah, no, I think it's a $64,000 question because in the public markets, people do pay attention to multiples and premiums and things like that. I think it gets back a little bit to just, we'll build a business model and it'll get back to how much of those synergies do we want to share with the target. And so at some point we have a process and we have a discipline and we need to stick with it. And, unfortunately it may mean that we need to walk away from stuff over a 5% price difference.
I thought it was fun to watch the data domain deal. Right.
Yeah, I
don't think that Joe expected to pay that price, but he expected to buy that company. And the outcome of it is one of our fastest growing businesses. So when you ask the question, was it worth it? I don't know at the time if we really thought about it, but we did have a view into where it would take us.
Yeah, so we're trying with the public investors, we're trying to educate them on, try and get away from that near-term accretion dilution analysis, which constrains how you think about deals. We find sometimes, in the heat of the deals, the boards, the perceptions around immediate stock price impact come to the fore versus the longer term views, and it's tough, right? If someone says, stocks can go down 5% because it's that much dilutive, Ken and I have had that conversation. It's tough, but it's sticking to that business case. But again, that's
we got in a similar situation with 3PAR this summer, and we knew exactly what we wanted to do. We knew where we would stop, and people looked at the prices as being kind of crazy, but the same thing you're experiencing with data domain, that acquisition's working out beyond our expectations.
Yeah.
So from that standpoint, it was worth every penny. So that's why I say in certain situations, if we know what we want to do and we know the strategic fit, storage is a $20 billion market. For us, it was a pretty simple thing, but it was pre-wired from the outset.
you guys did a good job in that transaction of communicating with the street in terms of the long-term vision. And I think a lot of times where you see stocks get clobbered out of the gates is maybe it's a dilutive deal, and what's going to sell the story and get that stock to have the support is the long-term vision, not next quarter, but 5 years out. How these things going to get integrated together.
But I'd say one of the reasons why Data Domain was so successful for us is we kept that business as its own operating business unit. We kept the people there, and then we took the other data protection technology that we had and we integrated it into the existing Data Domain management team, and that's what made it so powerful.
So can I ask a question to you, Andy? So would you actually integrate? So how do you know? There's two great examples of unintegrated businesses. How do you guys decide what's going to maximize that?
I think it depends a little bit on what it's coming. So in 3PAR, it was integrated right into storage because we have an existing storage business. Now Vertica, which is interesting, we just closed that deal a few weeks ago. That will stay as sort of an incubated business and then working with other business units. Actually pretty similar to the VMware model because we see a lot of different places we want to put it both inside and outside HP. So we are experimenting with some different models, but in most cases there's a hosting business. But I think more and more, and particularly maybe even in the cloud situation, you'll see us do some more incubation type of integration, particularly around some of the cultural issues with small companies that we want to make sure, particularly on some of the smaller companies that don't have what I call exit velocity when they come into HP. We want to get them to exit velocity before we put them into a bigger organization. So we're actually having a lot of success in some of the things we're doing around integrations with smaller companies over the last year or so.
And to that point, when you mentioned putting two storage businesses together, we just acquired Isilon, and we're operating it as a separate business unit. And I think part of that is understanding that that is a West Coast culture. And if we integrated it into our East Coast culture, that it may not be as successful. So they are operating separately.
I would say that's part of the pitch you guys can make when you make the initial approach to people. When you talk to some of the companies here, is kind of, we get asked a lot, in a situation, hey, have they done this before? Have other situations worked well? And so obviously we're trying to find those kinds of situations. How did so-and-so integrate well or not? How they deal with cultural sensitivities because they've got a long runway ahead. And so I think leading with some of that positioning will be helpful for you guys.
So Sheryl, you talked about Data Domain, you talked about Isilon. What other technologies are EMC excited about in 2011?
Yeah, so the acquisition of Greenplum is very big. So data analytics, and we're looking at that as another model, a VMware model. So how can we turn that business into a franchise? So they have a whole M&A team looking at what they need to do to develop and grow that business. So that's a very specific area.
Can I see a show of hands in the audience of data analytics companies?
Okay. I have a few business cards.
Good to hear. Andy, how about you? What are you guys excited about? What can you tell us about HP's roadmap for M&A in 2011?
So, well, I heard Leo kind of laid it out. No SAP is what I heard. The interesting thing about HP is when you think about the breadth of what we have, there's a lot of mouths to feed, as we like to say. But I think software in the cloud. I think Leo probably did a nice job of explaining kind of what we're looking at. But everywhere from, we're going to help companies build clouds. We're going to help put services on clouds. We're going to help people manage clouds. And I think he probably underscored the importance of, we see this sort of hybrid world going forward. So, almost any acquisition we do these days, Vertica is a great example. It's pretty much an on-premise solution today, but we spent a lot of time and diligence understanding sort of the cloud applicability because we see this hybrid world being very important on the enterprise side. And then the last piece of that is, if you think about the Palm and the connectivity side of what we do, we're very focused on, how do we help people connect to the cloud. So it's really, you can think across that whole value chain of the cloud. And given HP's assets today in our different business units, you'll see us do stuff in all those different areas.
Paul, Ken, what are you seeing as the sectors that are hot and getting traction?
Well, one thing that we're seeing a lot of is, actually, if you just look at the data over the last 12 months, most of the acquisitions that you could put in the cloud category have been around data analytics or infrastructure, right? So there's the whole storage wave that happened in the fall. There's the set of assets that IBM has rolled up with SPSS and core metrics, et cetera, to put under the Unica umbrella to use for marketing analytics in the cloud. And then the other thing that I would note is just purely getting scale in terms of public cloud infrastructure. Right? There's obviously the Terramark deal. You could even look at things like T-Mobile and sort of the on-ramp onto the cloud, just simply gaining scale, which ultimately for undifferentiated clouds that don't have proprietary software solutions inside of them, it is going to be a scale game. It's kind of riding down the cost curve, and the more infrastructure footprint that you have, certainly that's going to be a key theme as we look forward over the next 12 months.
Yeah, I think some of the things we're focused on, just from a thematic standpoint or a business model standpoint, are grow the business as quickly as you can, but really understand the unit economics of your customers. In SaaS and on-demand, we've been lucky to be able to articulate to investors on a customer lifetime value basis. It's very profitable. Don't look so much at the overall GAAP financials, which could be less interesting. So that's something we've done successfully. So really understand customer unit economics, which allows you to drive the growth once you understand the profitability. The second thing is the convergence we're seeing vis-a-vis SaaS and cloud. So lots and lots of companies are coming into the space that care strategically. I don't think anyone thought Adobe was going to buy Omniture. We've been working on that for quite some time. That's worked out very well. You're going to see, the Ciscos of the world, the ADPs, certainly all of the big IT leaders, the three-letter acronym, two-letter acronym companies, but also other companies. And so understand where potential partners can come from. And the third thing we think is really important is, again, that culture and DNA aspect. We continue to see acquirers ask us for simple things like, hey, get us the resumes of the top 20 engineers at said company. We want to know what development technologies are they using, what are they doing, because we just don't have that as we as Big Co try to morph into the next version of things.
Just, again, on the theme of trying to give some helpful tips to our CEOs in the audience, how do you guys source deals? How do opportunities come to you, or how do you go get them? Andy, how far in advance of a deal do you start planning, either the acquisition of the company or the acquisition in the space?
Yeah, I think it depends a little bit by sector. We do try to be relatively proactive. I think some of the larger deals that we did last year, we had gone to our board in January and said, here's our roadmap for the year. And obviously things happen and things change, but in that case, we did have ArcSight, we did have 3PAR, we even had Fortify. It gets a little harder as you get to smaller deals because HP is so big. But from a sourcing standpoint, we work pretty closely with the business units because it all has to, M&A is a means to a strategy, right? So everything has to contextually fit into the strategy of the business unit. So we'll work with the business units and, to try to develop a depth chart of companies that fit where their gaps are, because they obviously, HP spends $4 or $5 billion in R&D, so we've got a lot of existing projects. And so a lot of it comes from the grassroots work with the business units. And then, we obviously have great relationships with the banks, and they'll come in and talk about stuff. But I tell you, the hardest deals we do are the reactive ones. And one of the things we spend a lot of time, and something we're trying to do a better job, is I was saying backstage, we've got more inbound inquiries this year, unsolicited, and kind of the point you guys were making, we kind of scratch our heads a bit because to us, unless somebody's in a competitive process, the board's decided to sell the company, we kind of scratch our heads, especially the younger companies, as to why they're kind of coming to say, hey, we think we're a good M&A candidate. And you'd be surprised at how many companies actually come to us. I'm sure IBM and TMC, and they say, hey, we just heard Leo's speech. We think we fit exactly with what you're doing. Can you crank up the team? I'm like, I've got 100 emails right now. I've created a folder in my email exchange, which I call unsolicited inbounds, which that's the only way.
That's where all my emails go.
Well, to that point, Andy.
No, just Mike White. So it's a combination. Bigger deals, we feel like we have a roadmap for the ones we want to do over time. Smaller deals, it's a much more iterative process with the business units.
I would definitely say that I think partnering situations have worked well. I think even we sold a security company to CA last fall where they had done some joint customer work. So SaaS play, so another CA doing SaaS, et cetera. They'd done some joint customer work, meaningful deals. right? But not a huge number. And so that spawned a dialogue. And so again, I think if you go to, Andy or Sheryl with, hey, at XYZ customer, we're working together, you can see the fit or the concrete evidence, that allows you to, not to speak for you guys, pull in the business unit a little bit more quickly and build that case.
I would say for us, the Fortify acquisition was probably the poster child for that, where we had a partnership. The business unit got comfortable. We could see the synergies of the two product lines, and so it made that one very easy. But yeah, I think that's a great point. That it helps to be engaged with customers before you start talking to the M&A team.
So be an HP commercial partner, be an EMC commercial partner to really have the most credibility. And
but it's good proof points. It tells us that you do have traction with customers. The business unit kind of has buy-in that this stuff is real. And that sort of thing.
And it also gets back to you have the business relationships, so you know how to work together, and that's the cultural discussions that we were talking about. Yes.
What practical advice could you give a CEO in this room, Andy, about how to be ready for this, how to plan for a future liquidity event, with HP or another, big company?
Part of it, I would say, don't plan for it. I think it's do the things that Sheryl and Paul were just talking about, is engage with the business units, get some customer, and bring us customers. There's nothing that gets a business unit more excited than a working relationship in the field. I'd say the other thing, and that this is a little bit more of a logistical thing, is the single biggest things that slow down a deal for HP is when we find out the house isn't in order. Stock options weren't done properly. Commercial contracts are a mess. You would be surprised at how great the strategic fit is, how great the financials look, and then if we run into IP issues, bad customer contracts, 409A issues, the thing can come to a screeching halt. So I don't want to overplay the mundane part of the deal, but the reality is if people want to get that check in the bank, those things can be real deterrents in a deal for it. So this isn't a commercial for you guys, but hire good lawyers and get the house in order.
Well, I'm glad I brought business cards. Paul, Ken, any closing thoughts from your perspective as we're close to being out of time? And I did want to open up to the audience for a few questions, time permitting, on things that you see that CEOs do that make their process better.
Well, I think it's along the lines of what we're talking about in terms of the partnership, to the extent that the CEO can, and actually with the help of their advisor, really kind of look through how the business is going to get integrated once inside of HP or once inside of VMC, et cetera, right? And to the extent that you can really tailor a story in a meaningful way, as opposed to kind of having the plain vanilla unsolicited inbound, right? That's exactly where that email or that inquiry is going to go, to the extent that you can really tailor the message, even before you even talking about M&A, tailor the message to exactly what these guys want to hear. That's really the recipe for success, I think.
Yeah, I think for this year and next, I think finding the potential business partner, strategic partner that's not the usual suspect probably has the highest ROI from a BD standpoint and from a M&A competitive tension standpoint if you go down the path we've been talking about. And I think thinking outside that circle in your space, broadly speaking, and I think you'll see more deals of kind of people from left field, right field coming into that core SaaS cloud space. That's going to be the big trend next 18 months.
And I was going to add something you and I were talking about. Make sure you get upgraded when you're flying. You never know who's going to be sitting next to you. You may have a deal right in seat 1B.
Yeah, I see 1B, Sheryl. I'm in seat 27C.
You're going to miss that deal then.
Just to be clear.
The HP employees are definitely in the back of the plane.
Upgrades.
Before I close out, I wanted to give just 3 questions from the audience, if anybody has anything for our panelists. And first, man in the front row.
It sounds like HP's that the mobile strategy is important for HP, the connectivity and mobile. And yet the web OS doesn't have a large market share at the moment. Would it make sense for, I know you're trying to build a larger market share, but it may also take some time to get app developers to join the carriers. Would it make sense for HP, or what would be your comments or thoughts about perhaps acquiring the Win BlackBerry?
So the question for everybody is HP going to buy RIM?
Yeah.
I'm sure Andy's going to answer that.
Well, no, I think we made our choice with Palm. And by the way, I was on the Staples website last night. I think you can at least see or pre-order the touchpad. And if you haven't seen it, I'm not trying to be walking commercial, but it is a very cool device. So no, I think our Palm is our play, and we've got a lot of good plans coming out over the summer. The products are coming, so I think as someone once said upstairs, we think we're in the second or third inning of that game. So I don't think you'd see HP buying RIM, although RIM is a great customer for HP.
John.
Question for you guys. Two of the biggest acquisitions last year are Prepar and Chamberlain were both public companies. I've heard from some investors and some CEOs of privately held companies that they want to wait before they go and do M&A discussions with buyers like HP. Can you guys comment from the seller's perspective? Are they waiting to go public as a way to get an auction up, get a higher price and valuation? And as a buyer, HP, do you have a preference on the public-private dynamic that Prepar and Chamberlain has shown?
I think it's changed a little bit with the some of the IPO market activity in the last, call it, several weeks, both in terms of the pace of filing, some of the private market valuations, and some of the recent activity. So I think if you went back to January or December, I think kind of New Year's resolution was build scale, build distribution, let's have a much bigger business to kind of have that kind of outcome and get to that scale. I think right now a lot of the boards are thinking about that IPO timing consideration, and one piece of advice I give you there is the IPO market, in our view, still remains quite rational in pricing these deals. They work very well, but if they gave you the multiples for some of these deals, you'd find that they're actually quite reasonable. And so that would argue for continue to build a business and not trying to force fit an IPO just to get out there because it seems hot, and go to your conclusion of building scale for the strategic exit potentially.
Yeah, I would agree with that. I mean, I think certainly in the private company market, I said it before. To the extent that you want to get liquidity, you should start not thinking about liquidity, right? And really build the business and work towards an IPO at some point. And again, if somebody comes knocking on the door, the Chamberlain deal is actually, that's a public company example, but that's a good example of they weren't looking to sell, right? You can read the merger docs, and I mean, this is public information, right? It was much more a situation where Dell liked the technology, and they started doing some things on the customer level, and it turned into a deal. And again, I think in terms of the sell sides that both Paul and I work on, the best transactions at the end of the day are the ones where you're really not looking to get bought.
Yeah, Isilon, same thing. We were on Isilon as well, and Chamberlain, and they weren't looking to get.
I'm paying your paycheck. What's going on here?
And you can have my upgrade voucher for the flight back. I've got like 75 of them. So.
Okay.
Do we have a last question from the audience?
A few years back, we saw a whole bunch of web-enabled tools coming out, auction environments, IPO, pricing mechanisms, and so on, to try and change how M&A actually occurs. I wonder if you see cloud-enabled tools being applied to your businesses, and if so, how?
That's a really interesting question. I think the auction is a whole debate unto itself, which would take another half an hour. I think in our business, we are trying to push our services out to our constituents in a more interesting way. We do a lot of work with Adobe Flex. We've won some awards for some next generation trading apps we deliver over the cloud to institutional clients. So perhaps that's not the specific question you're asking, but as an institution, Morgan Stanley has a CTO summit we have every summer out here, where we bring our IT team out, all 30 key VP level execs, and cloud is certainly a big event. We have a cloud computing forum in 2 months in New York. So as a firm, we certainly are focused on it in terms of to do deals and pricing and those sorts of things. I haven't quite seen that happen, although we did take Intralinks public, which is a SaaS company for online data rooms. It's done great, and maybe that's a part of the answer.
Yeah, in terms of the tools being applied to our business in terms of running processes, I think maybe that happens someday, but not for a long time. It's a very personal business. It's you're making introductions. It's you gotta see the product and talk to people face to face. It's applying auction-based formats. I mean, maybe for not the business that Paul and I do, maybe for very small sell sides at some point, but I don't see it anytime soon. But certainly in terms of our use as a firm, to echo Paul's point, we're on Twitter. We're using social tools at Blackstone to kind of market our services and also to give our opinions. I mean, much of this, the discussion that we're having here, will actually go on our website and be in the social sphere. But again, to the extent that we're talking about using tools for processes, I don't see that anytime soon.
I'll say that from the legal service provider position, we're certainly trying to take advantage of all of those technologies. We run 23 blogs on our website on a variety of different discrete topics. We're using a lot of web-enabled technologies to manage who gets alerts on those blogs. We're setting up our own online data rooms that we make available for our sell-side clients in M&A processes, and are like the rest of business using outsourced servers and other technologies to be more efficient. So none of us, I think, are immune from the marching forward of time. But with that, I want to thank our panelists, Andy Johnson from HP, Ken Allen of Blackstone, Paul Kwan of Morgan Stanley, and Sheryl Chamberlain of EMC. Thanks so much.